All right, welcome everybody. Everybody that's on, this is Steve Cooney. He's actually at a baseball game right now, coaching his kids, and he's taking the time out of his busy schedule to come on here and talk to us about mortgages. So Steve's been in the mortgage business for 16 years now, since 2005. So he's very knowledgeable on the subject, and we're really excited to have him. Even though he is in a truck, but you know what, he's still going to give us some knowledge. And then also we have his assistant, Barb Shatrand, and she's going to also be talking to us. They're going to kind of bounce off each other and kind of give some insight on the mortgage process, whether it be credit, assets, income, anything like that goes along with the mortgage process. So I'm going to hand this off to Steve. And again, thank you for being here, and we're looking forward to your talk.
You bet. Thank you, guys. Appreciate you having me. So I'm actually out here at the Desert Fields, about ready to coach a baseball game. So I'm going to talk for a little bit, and I may have to leave to go coach little guy. You have a 10-year-old son playing some Little League. I talked to Kelsey about this. She actually thought it was a pretty good idea to kind of show you guys like good work-life balance. You know, I got a job, professional, but I also spent some time just out here on the ball field coaching my kiddo, and I just thought that was just wanted to show you that. We're Team Blue Jacks right here. We got Mount Jumbo, West Side Little League. So go Blue Jacks tonight, right? So anyways, I'll get back. I'm kind of in the mortgage. So pretty much mortgages are they're really a black and white industry. We're a very regulated industry. We're probably one of the most highly regulated industries in the world. So what we do is very, very black and white. That being said, I don't want to discourage anybody thinking like, oh, they're black and white. It is what it is. We are also creative, and we're financial advisors. So we want people to come to us, and we want to figure out programs for people, because there are an array of programs for everybody. Starting off with myself, I've been in finance since 2001. So I'm over 20 years now, which absolutely seems crazy to me. I've been in the mortgage industry since 2005, and basically been rolling since then. I lived in Kalispell for a couple of years, did them up there, moved to Missoula in 2007. Since 2007, I pretty much have been in the same position. I've worked for a couple different companies, but they're all the same company. They all kind of rolled in into one company, which ended up being what is now called Opportunity Mortgage. So really my date of employment with Opportunity, if you were to go back, is December of 2007, when I moved down from Kalispell. I've worked with Barbara since 2007 as well. So when I moved down, we brought Barbara on board, and so we have been together for that long. So we have a lot of knowledge in the industry, and we work as a really close team. She is literally my right-hand gal. I could not do it without her. I love her. So whatever you guys need to ask, if I have to step off, Barbara's awesome. And if we don't know the answer to some of your questions, please just email us. We'll give you some contact information. Call us, text us. We could always figure out some answers to your guys' questions, because there's a lot of information out there in the mortgage industry. And not everything rolls off the top of our tongue, believe me. We have to do a lot of research. So let's just a little bit about us. Again, I tell you, we work for Opportunity Mortgage. Opportunity Mortgage is basically the mortgage company for Opportunity Bank of Montana. We're about the top 3% mortgage company actually in the state. A lot of people may not know that. Our bank has been around since the early 1900s. So we have a pretty good established just footprint within Montana. We are a Montana-based bank, so about probably 95% of the people that work for Opportunity Bank of Montana actually live in the state of Montana, are employed in Montana. We have a few remote workers and stuff like that. The mortgage industry heated up really heavily this last year, so we had to hire outside the state, even just good underwriters and stuff like that. But they are all employees of Opportunity Bank in Montana. we service most of all of our loans, which is kind of uncommon for a small Montana bank. And the only ones we don't service are, government loans, Montana Board of Housing type of loans, and some jumbo loans and stuff like that. Just things that are easier for other servicers to service. So that's pretty much talks about just me, Barb, our bank, and kind of our establishment here in the market. Jumping into mortgages, like I said, mortgages are pretty black and white. So I'm going to give you my basics on mortgages and really what I feel are the most important aspects of mortgages. I'm going to start off with programs. There's an array of programs for people. A lot of people think that, I have to have 20% down to buy a house. I've got to have great credit, great income, great assets, or I'm not going to get a house. And I just want to tell everybody up front that that's a total, it's wrong. There's an array of programs. Start off, you do have your conventional mortgages. Conventional mortgages can range from anywhere from 3% down all the way down to as much as you want to put down. And you have your FHA mortgages, which is a government-backed mortgage. That's a 3.5% down. But you can couple a lot of these mortgages if you fit into certain criteria for income and stuff like that with like down payment assistance programs. We have opportunities to give out, like there's people that give out grants for some of these things that actually give you the money. Or there's just down payment assistance programs where they'll have like silent seconds. And what that means is you don't have to pay back that second mortgage until the end. You basically can you have it. They gave you the money as a second. It's kind of silent, sits behind the first. And then as soon as you were to sell or refinance, you could pay back that second mortgage. So it's just ways to get some extra assets that will go towards the mortgage. We have VA loans for vets, rural development loans, which are 100% loans. They do have income qualifications. You can't make over a certain amount for some of these. The rural development, one thing with that is they don't let you buy right in like city limits. They are rural loans. Rural development, they're outside city limits in the county, Lowell, Frenchtown, those type of areas. But again, they're awesome loans. 100% financing. If you can fit the box, the matrix, great loans for people looking to trying to get into the market. If you have a lot of money, doing really well in your business, we do jumbo loans. The jumbo loan, anything over a loan that is $548,250 is considered jumbo financing. So they are tough loans. They tend to take a little bit of time. They have a lot of different qualification guidelines and things like assets and reserves for monthly reserves and stuff like that. So a lot of time, most people in this area try to get their mortgage down below that, but they're absolutely, if you fit the box, they're good loans. We do renovation loans, home style renovation loans, and construction loans. And basically that kind of gives you an idea of what my opportunity has it all, really. The down payment assistance, you have things like Home Start. Montana Board of Housing has those second mortgages. There's one in Missoula called Home Now, which is a great loan that you can put with either conventional financing, FHA financing. Again, a lot of the down payment assistance programs, you've got to make sure that you qualify because their eligibility matrix is a little bit, you can't make a certain amount of money. They want to cater to people that are not making a ton of money that they're just going to go give these funds to. They don't, they want to make sure that they're people in need, that they want to get them into a house and they want the house to be affordable for them. And so they're not going to just give it out to anybody. If you're making, 125,000 or so, they're not going to give it. They have upped their income limits for certain household sizes lately. So they do go for like a household of let's say 3 people. So husband, wife, and a kid. They are up into the low $100,000 range for household income for that. So just something to keep in mind. You have those. with mortgages, before you go look for a house, I would highly encourage, and I would say most of all your real estate agents out there are going to say the same exact thing as me. Get pre-qualified. Go into the bank, find the mortgage lender you're wanting to work with, and just get a loan in the system. Anytime you put a loan in the system, the worst thing that's going to happen to anybody, opportunity that I could tell you this, I don't know what other banks do. We don't have an application fee or anything like that. We pull your credit. So you get a credit hit. So then we can come up with ideas. I mean, if you don't think that you might qualify, you just have totally thought, I'm priced out of the market, I don't fit any matrix, you might surprise yourself. So I encourage you, go get pre-qualified, get your credit pulled, and see what happens. I mean, have your mortgage lender work for you, because again, we are advisors, and our job is to find the program that's going to fit. And if it doesn't fit, the mortgage lender, if they're a good mortgage lender, will know how to help you get fit into a program. You know, timetables, like, hey, do this with your credit, pay this off as far as this credit card, pay this credit card down to this certain amount, save up this much money. You know, you can come up with all sorts of different scenarios, especially with all the programs out there. So if somebody will take the time to do that and allow you guys and give you the time to meet with you, get the loan in the system, and just come up with ideas, then, you know, you might surprise yourself. Because I mean, I always hear people say, you know, when they are talking to real estate agents, real estate agent might call me and say, I want you to talk to these people because they don't think they could buy. So I'll give them a call. And the first things I hear is, I don't have good credit. I was like, but you know, you might have better credit than you think. And a lot of these programs will go down to like 620, some even maybe even a little bit lower than that. So I don't have the assets to buy. I don't have the income to buy. A lot of programs, like say if you're a vet, they don't even have an income limit. Yeah, they might stop you at a certain point, but there's flexibility in a lot of these programs. That being said, when you're buying your house, when you're going to get pre-qualified, have an idea in your mind what your budget is. This is my budget. This is what I want to spend. This is what I want to afford on a monthly basis as far as what my budget is. But be flexible in that a little bit. You know, give or take $100 or so, because in the market you might find that, you know, if you spend another $50, you might end up with something you actually like versus not. But set your budget, but also know that can fluctuate just a little bit. But you want to have a good idea of where or range what that budget needs to be at. Different types of things that just to keep in mind that we do a lot of co-signer loans, parents coming in, co-signing using their income. We do a lot of loans with gift funds, so family members gifting funds, people using their retirement assets as part of a kind of like a down payment. They kind of borrow off their, like, let's say they take out of their 401k, they pay back their 401k, but their assets that can be used to buy and put down some money up front. If you absolutely have to have some money down up front, you don't qualify for one of the down payment assistance programs. So don't let yourself talk yourself out of at least trying to see if you're interested in getting into the market. You know, a lot of people probably wish they would have gotten to this market a lot sooner. This market in Missoula has gone crazy, and it is just, it's booming. And not to discourage anyone, it's hard to get in though. I mean, I'm writing pre-qualification letters right now for the same borrowers over and over and over again. Sometimes, you know, I'll send out 15 pre-qualification letters as people are putting in offers every single week and getting beat out. But don't let that discourage you. You know, get in right now, because Missoula and Montana in general, it's a pretty hot area. And you being locals here, you know, get in and try to get into that market, because it's probably better than renting right now. Plus the equity position that you're going to get, and equity is basically your what you owe, what you owe on the mortgage compared to what your house is worth, and that just continues to increase. So it's an asset for you guys as well, to almost like a savings account over time. Probably the most important part that I think the most important part of a mortgage, and the first thing people need to work on, or if they already have it, it establishes credit. Credit is it's so important with a mortgage. It doesn't mean that you will not get a mortgage if you have some credit that's a little shaky, maybe not as good. It just means there's a lot of money to be lost within a credit score, or you can, if you have a good credit score, there's a lot of money to be gained. And what I mean by that is our rates are driven and our programs are driven by credit. So if somebody comes to me and they have a 740 credit score, they're going to get a much better interest rate than they would be able to, than somebody who might even have like even a 700. Their credit scores are broken up in our industry on like a 20%, not 20%, 20 point system. So let's say on conventional mortgages, we will do a mortgage from 620 and above. So 620 to 640 is going to have a low, like a pretty low interest rate, or sorry, high interest rate, not low. I didn't say that. 620, 640, you're going to have a higher interest rate. 640 to 660, even higher. 660 to 680, even higher. Or sorry, it starts to go lower as you go higher up in your credit score. So, but you guys could see that just to make sure when you guys are, if you're preparing to buy in the future, start looking at your credit. Get on Credit Karma, see what it might be at. And if you wanted to, you could send me like, hey, I have this and this and this score. You're probably going to be lower on a mortgage score, but I could tell you, I can take a look at it and say, okay, let's say you have a 680 on Credit Karma. I could say probably 660. If I were to pull your credit on what's called a tri-merge, which is the 3 bureaus out there. So we pull the tri-merge. Our credit scores are always a little bit lower because they have different algorithms on ours that are real, instead of not, Credit Karma only has a few. So we could take a look at it and say, hey, if you were to pay this credit card down to, $600 versus having a balance of $1,500, your credit would probably increase 40 points, which could lower your guys' rate by 0.25% on a mortgage. And I'm going to tell you, 0.25% on a mortgage right now, or for whenever, $100,000, $200,000, $300,000 is a lot of money over time. I mean, it's a ton of money. So that is I always preach and try to coach credit with my borrowers. Because I want, if they're going to get in, that's fine. They can get in. If they want to take what they can take right now, even if their credit's a little lower and they still qualify, that's fine. They can always come back and refinance the mortgage and try to get it when the credit goes up. But just if they want to say, hey, I want to buy in 6 months, then pull something through Credit Karma, or just come in and get pre-qualified. I could pull a real credit score, and we could start setting a goal. Like if you were to do this, and this, you're going to get there, because credit is about it is the most important thing. I have a little sheet here. I'll kind of give you an idea, guys, of how credit goes. 35% of your score is determined by payment history. So out of a 100-point system, payment history determines 35% of your score. 30% of your score is determined by how much you owe, so amounts owed on credit. So as far as like let's say you have a credit card, the max limit's $3,000. You want to try to be at about a 30% or lower balance on that and keep it there throughout the month, especially right before your billing cycle, because usually like Citi Card or Chase Card, they will report your credit and your balance right before they give you the payment, which is kind of jacked, a little bit jacked, because you guys usually pay after you receive the credit statement. but they're reporting the balance before they send the credit statement. So let's say you maxed out the card, you have a $3,000 balance, but you pay it off every month, and your credit limit is $3,000. When they report it, and then you haven't paid it because you haven't gotten your bill yet, what they're going to do is show you that you're maxed out on that card. So they're going to show a maxed out card at $3,000, which you can see is going to affect 30% of your score and show that you have a maxed out card. So what you really want to do is pay that before you get the bill. So keep an eye, get online, get the apps through Chase, Citibank, Bank of America, wherever you had, and pay your balances down. Figure out when your statements come due and do it probably about a week before. So when that statement comes out, your balance is low. Talking to Barb about this earlier, one thing I see a lot of, which affects a ton of people's credit, people get annual fees. They get annual fees like on their, let's say they got an Alaska credit card, and Alaska charges their $75 or whatever annual fee, and all of a sudden the person didn't have a balance on it. They had zero balance, and they didn't think they had anything to owe, and they missed their statement, didn't think they had to open their statement from that card. Keep an eye on all of your credit cards at all times. Know which ones have annual fees and which ones might be coming due with annual fees, because if you miss that and all of a sudden you're down 30 days now, 60 days now, 90 days, 120 days, and now your late's reflecting, and you were up at like a 780 credit score, your score can be 640 before you know it, 620 even. So keep an eye on those fees, and just know those annual fees do come out, and know which cards have them when they come due, and make sure you pay them, because some people just don't use their card, and then all of a sudden they have an annual fee. They just didn't open their statement, they let it go, they shredded it. But I didn't know anything on the card. Well, you might have. So again, 35% is payment history, 30% amounts owed, 15% is length of your credit history, 10% is new credit. So that new credit can kind of affect you negatively. So having some seasoned credit's very good. So if you don't have a lot of credit, get some open, because that's the only way you're going to get credit. I have a lot of borrowers come in like, well, I'm going to have good credit because I don't have any credit. I'll pull their credit and they'll have absolutely no score. And I'll be like, well, you got to go open an account, 2, 3, to try to get some credit established and keep those balances low, but just use them, and then come back to me in 3 months, because now you're going to have some established credit history. And then lastly, 10% is types of credit used. So if you're using installment loans, credit cards are good. And a lot of people that's another misconception, that they're not good. They are good to build your credit. You just don't overuse them. Use them wisely, and try to not max them out. Try to pay them off, pay them down to at least 30% before that billing cycle, and allow your credit to gain to get you guys to save you money. Like I said, quarter percent is more than what even banks are giving out on like CDs right now. So you can see, like, you have a $300,000 loan, 0.25%. If you were to get a better credit score, is going to help you guys out a ton. I had a few little do's and don'ts that I have on a piece of paper. I'm going to read a couple. So a couple of do's, goes down to credit. Keep making your existing payments, whether that even be rent, utilities. You don't want to go to collection. Make sure you turn in your Bresnan and Spectrum things. I see a lot of collections for stuff like that, like their routers. If you're in the process of getting a mortgage, respond to your mortgage lender, because mortgages are very time sensitive as far as closing dates and all that stuff. Some don't. There's not a lot of the do's or a lot of the credit. Make sure you get stuff in. Don'ts. I like the don'ts better. Don't take on any new debt, especially if you're in the process of getting a mortgage. We will check to make sure that you haven't pulled your credit. And if you have, you went to Furniture Row, if you're buying a house and you pulled your credit and you got new credit, we're going to have to add that in, and we will know that you did it, because we're going to check what's called a soft pull. Like, again, don't delay in any sending any of your information in. Do not make any large deposits that are gonna offset. Like if we look at a bank statement and you make any large deposits, we're gonna ask what it's from. We're gonna find out if it's gift, if it's loaned money. So keep your bank statements even keeled. If you're gonna have to make a deposit, talk to your mortgage lender. Don't quit your job. I've had multiple people, we get down to the very end and they think they're done. We do what's called we just call and just make sure you're working on the day of funding. So it's super frustrating. I know probably for us, more so for you guys, if you were to buy a house thinking, oh, I could quit my job, I signed today. Well, we call to make sure before you fund if you're still working. So, and you'd be surprised how many people do that. And then never hesitate to contact your mortgage lender. They should always be there to help you out. Next thing, guys, market. I've kind of touched on it. The market's hot right now. It is a tough market to get into. Houses are still coming on the market. There's not a lot of listings here right now, but there's building going up. Building costs are high, and prices are high here. But don't let that discourage you. There are things out there. I have people making offers, getting accepted, still doing down payment assistance programs. So just don't let it discourage you. Go out there, get a hold of a real estate agent, get over the lender first, get pre-qualified, then get a hold of a real estate agent. Start getting emails on what's coming up. If you get into the right house at the right time, the seller and you connect, like through a letter or something like that, you can get that house. Right now, the one thing with buying in this market, even though the prices are a little higher than we've seen, rates are awesome. They are at all-time low, and we'll hope. I'd love to see them stay down this low or be here for a long time, but we don't know. And they can trade and they can change on any day for the negative or the worse. They're not like mortgage, or they're not like auto loans. Mortgage loans are a daily thing, and they sometimes change throughout the day, but they are so low. So let that be encouraging, because right now your payments could be a lot lower, even though prices are higher. That being said, if you do own a house and you think you missed the refinance boat, you haven't. Rates are still all-time low. They're a little bit higher than they were earlier in the winter, but they're still super low. We're still doing plenty of them, still saving people, sometimes hundreds of thousands of dollars. Honestly, I break down each time on my calculator how much they'll save based off of going from, let's say they have a 4.25, 4.5, and now they're going into the low fours. You haven't missed it. Trust me. There's a lot of money to be saved. Other than that, guys, I can't think of a whole heck of a lot to tell you guys. I think I covered a lot of the mortgage industry. So if you guys have questions, I have a few more minutes I could stay on here. I think maybe answering some questions would be good. And then I'll kind of give you guys my contact information before you leave, and then Barb can give hers. And if you guys want to write it down, I don't know if it was up or anything, so I'll just kind of tell you. Again, my name's Steve Cooney. Work at Opportunity Mortgage. We're based out of Missoula. Our office is right by the mall. It's the 1821 building. It's that 5-story building. My phone number, I'll give my cell phone is 406-214-2550. My email, if you want to email me, is scooney, that's COONEY, at oppbank.com. If you have any questions that are not answered, or you think of them after this, please feel free to reach out at any time.
Hey,
Other than
Steve.
that, let's go to questions.
Hey, Steve. So
Can
you hear us?
I can hear you, yeah.
This is in the war room here, right? Where everybody's here. We had a few questions come in, and we did put your information in the chat box there. So one of the questions that came in, I'll kind of rattle off a few and you can go off them. Student loans and how those can affect your credit. what is a comfortable credit score to start looking for a mortgage? And what was the last one?
What seasonality of rates?
Oh, and what seasonality are there with mortgage rates, usually in a normal market instead of maybe right now where it's kind of crazy? So those are 3 questions we had here for you.
Okay. So student loans, they have, I mean, they're going to affect your credit as far as like having an installment loan on there. The installment loans do not have as much effect on the credit unless you are missing the payment. But anything you're making a payment on is going to have oh, sorry, hold on one sec, guys. Am I back?
Yep, you're good.
Sorry, somebody was giving me a call. I had to decline it. So as far as like just helping the credit, if you are, sorry, if you're making the payments, any of that's going to help the credit. I don't know the exact amount, like if it's going to help you 10 points or anything like that. Missing the payments, I could tell you right off the bat, it's going to hit you hard, like really, really hard. So I do see, that's another thing. That's a good question. As far as student loans, I have had a lot of people think their student loans have not come due. So all of a sudden, people will be missing student loan payments because the word is just slipping my mind. Their deferment or whatever on them is up. And, you know, all of a sudden they're not realizing, oh, I got to make a payment to my student loan. I've missed 60 days of payments. There's where you're going to get a big hit. As far as student loans go, like one thing I can tell you, a lot of people do have their student loans in deferment. And if they are in deferment, there's a couple different ways we can qualify people based off the student loan. So let's say somebody has $60,000 in student loans, but it doesn't show a payment. If we go ahead and what we will do on a lot of them is we will use 0.5% of we'll use 0.5% of the $60,000. So basically we'd use like $300 for a payment on that to get somebody qualified. Now, what they can also do is go to their, let's say they go to Navient or whoever they have their student loan with, and they can say, hey, I want to set up a income-based payment system. And they'll take if you get the paperwork and show us, we can use the paperwork to get people qualified on that. Otherwise, we use a percentage basis to get people qualified as far as the payments go. Does that answer the question on that one?
Yeah, great. Good.
Yeah.
Awesome. Yep. So comfortable credit score.
Comfortable credit score. That's a good question. I mean, I could tell you right now, the best credit score, anything over 760 is the best. That's the best pricing. If you have to have mortgage insurance, it's the best mortgage insurance. But comfortable wise, I mean, if you're wanting to get into a house, 620 works. But you just got to realize if we don't find the right program, 620 might have it might have a higher interest rate. I mean, so I'm going to say 680 and above. Usually our scores we can work with where we're like, hey, they're getting a pretty good deal, and you know it's working. So I'd say 680 and plus, but try to be above 700. 760 is the best though. 740, if you have no mortgage insurance, is still the best pricing, but you get hit mortgage insurance wise. And what mortgage insurance is, guys, is basically an external mortgage insurance company that we have, and we have I think we have 6 options to go through. They're different companies, anything over 80% loan to value. So what that is if you don't put 20% down, you're going to end up with what's called mortgage insurance, and it's tapped into your payment. So that's what mortgage insurance is. So 740 to 760, you just have a little higher mortgage insurance, but you still are going to end up with the best actual rate. And then from there, 720, 740 is great. 700, 720 still really good. So I'd say 680 is comfortable, but I'd really prefer people to try to get above 700. But there's programs out there you get a really good rate, like FHA 620 and above. Your rate's still going to be really good. They don't really hit you. It's conventional mortgages that hit you on the rate for lower credit scores.
Awesome, great, yeah, and yeah, we had a question in the chat, and then our last question we had here was seasonality for buyers. When is the best time for rates? And I know this last year has been kind of doesn't matter, but usually seasonality for buyers. And then it looks like we had a question from Russ about handling split loans with land and a build. So I'm assuming that would be a construction loan. And I think that's, yeah, the questions we have in the chat right now.
So there's no seasonality in rates, guys. The rates are driven like the stock market. So it'd be like saying there's seasonality in the stock market. What they are driven off are like U.S. Treasuries and bonds, and people buy them to invest in them. Different countries do, and it just depends on if people are buying into them. They're a very safe investment for people. So that's why mortgage rates are so low, because people have just bought into them, and the U.S. government has tanked a ton of money into them. They're trying to keep rates low. So there's really not a season for when to hit a low rate. They're all over the board. I mean, for us, they'll be low. Like last year, they got low in the spring, and they were low all year round. And then the late winter hit, and they kind of went up about a 3/8 to 0.5%, and they've kind of hovered in there, and they haven't moved since then. They've been very flat. So that's far as mortgage rates goes. The market, Brent, if you were on with Brent, I don't know if he ever mentioned the market. I mean, seasonality as far as the market goes, it's a real estate question, but what I see, I mean, a lot of real estate agents are talking about making an offer. I mean, tons of houses are coming on in the spring, so you're going to have a little bit more competition when there's actual listings, but there's really not a whole heck of a lot of listings right now. So right now it's just a seller's market regardless. But when everything kind of evens out, I'd say you can really buy at any time and get a good deal. But if tons of houses are coming out in spring, you can compete a little bit better with the sellers. But winter's always a great time, because some people are just they're only listing in the winter because they really need to get rid of their house. This winter, people were just listing because their houses were selling for $100,000 more than they could have gotten 2 years ago. So they were just like, we're going to cash it in. So these last couple of years have been super. They have not followed the market trend. And then the land to construction, basically land loans are out there. I do not do them. The bank does them. They're typically bank loans if they want to hold them. Land and construction loans, if you were to purchase a piece of land and get a construction loan, then I could do the land at the time of the purchase purchase the land and do a construction loan at the same time. Basically, all that is getting with the builder, getting all your plans, specs, bids, having the builder get approved, having his liability insurance, his contractor's license, make sure he's capable of building a house, especially right now because the way prices are in the construction industry. People have to, you got to have a good builder or they're not going to bid on a project, right? And people are going to be short. So we do them. Right now, we take the cost of the land, we take the cost of the build. So we take the two combined and we'll lend up to 20% of the total cost of land plus construction. So land does require some funds down. If you have a good builder you can work with or somebody you know, if you do a lot of the work, being a small town, small state bank, we do have some flexibility and some creative ideas where we try to use like maybe equity positions in I'm saving this because I'm a painter or just stuff like that. I mean, there are some times where we try to get a little creative and do it. Otherwise, typically you're going to take the two costs, 20% down, and then we'll start funding. They are bank held loans until we put them on the secondary market and refinance the construction loan. So what we do is we give you a construction loan, 12 months, you guys draw off it like a line of credit, and then we refinance the construction loan and put on in what's called the secondary market. That's like selling a loan to an investor, and then we hold it to service it. So I hope that answer your question.
Yeah, I think that was good. That was in the chat. We're trying to be respectful of your time here. I know you got a roll. We were thinking 6:15. I know you got to go coach a game. So if we want to wrap up there, and then we'll get Barb on, and Barb can kind of finish us out. And thank you so much for being here.
All right, guys. I really, really appreciate it. Thank you, guys.
Great job.
I'll talk to you later. And if anybody has questions, have them reach out to both of us, okay?
Yes, sir. We have your contact info in the chat, and this is also being recorded for anybody else that wants to watch it. So, yeah, thanks,
Okay.
Steve.
Cool, guys. You bet. Talk to you later.
All right.
Bye.
And Barb, if you wanna hop on and introduce yourself and kind of what you do and everything, that'd be awesome.
Hi, thanks for having me. I'm Barb Chatron, and like Steve said, I've been with Opportunity for a long time, since 2007, and I've been working with him for just that long. I've done many pieces of the mortgage parts, from the processing part to being a loan officer assistant. So I've had the fortunate opportunity to do things from the beginning to the end, which has been helpful in my knowledge of mortgages. There were a couple of questions I saw on the chat that Russ had posted in regards to the rates. There's no risk at 6.5% other than you are going to be paying a higher payment, but you always have the opportunity to refinance if rates were to drop. So if you're seeing news that things are going lower, I would definitely reach out to a lender and ask them where they are as far as rates go and where you see your payment going. And if you felt like that was going to be the best option for you to lower your monthly mortgage, then you always have the option to do so. We also can go down from 30-year fixed to 15 and even 20-year. So if you were speaking to your lender and you didn't want to start your term all over, you can definitely ask them for the rates for a 15 and 20-year. That way you're not having to pay the interest over the life of another 30-year loan. The good thing about potentially putting it to another 30-year loan is that if you were worried about your income, let's just say you have a fluctuating monthly income, you could then pay more when you could and have the lower payment from a 30-year if you didn't have the ability to have the stable income every month. That way you can budget for the lower but can pay more when you can. I hope that answers your question, Russ.
Yep, Mark. Yep, that answered our question. Sorry, we're couldn't unmute for a second.
Oh, you're fine. Does anyone else have any other questions?
That already got answered.
All right. Unless anybody is throwing anything in the chat right now, I don't know if we have any other questions. Let's see. Yeah, do you have any input on the market and what you see kind of working with Steve and kind of your experience, because you've been in this industry a long time, and just kind of what you would give to the young professional, some advice or, anything. I know me and you talked when I met with you and you had some good advice for me. So I don't know if you just wanted to throw some out there for everybody else.
I would kind of reiterate what Steve said in regards to, one, getting pre-qualified up front. just so you're able to set a budget in what you feel comfortable paying for a mortgage payment, and also seeing where you qualify as far as your credit, your income. Like he said, we can cater programs to your situation individually. So it's not entirely black and white that way, so because everyone's income and credit is different. So I would encourage everyone to get pre-qualified. There's no obligation for you to contact a lender and do so. And I think it would be beneficial so that you know where you stand, how comfortable you are with a payment. That way you can go to a realtor and say, I'm willing and able to be in this sales price range. And then they can start helping you find a home from there. Other than that, it's really, it's an individual piece. So you have to be comfortable with where you are in it. And you also need to be comfortable with your lender and your realtor and asking questions and what you don't know. We don't know what you don't know, so you have to ask.
Fantastic. Yeah, we had another question pop up. How long does a pre-qualification typically take if you have your documents in order?
So we can pre-qualify you in a day, less than a day. We don't necessarily need all of your documentation up front. We do need you to fill out an application, and you can do that online, over the phone, or in person. And then you can give us a rough estimate of what your income assets are. We can pull credit with your authorization that day and start giving you options immediately.
Fantastic. Awesome. Yeah, unless there are any other questions coming in, we can give it maybe a minute or so and see if anybody has any other questions. Yeah, we can just wait a sec, see if anybody's gonna pop anything in.
Russ, I think the question that you just put in there, are things do expire as far as documentation. So your credit expires in 120 days, and then your income assets is usually 60 days. So you'd want, if you're having a long period of time where you're not finding a home, we can always reevaluate every couple of weeks to see where you are.
All right. Well, I think that is it for questions. Thank you, Barbara and Steve, for being a part of this, and Missoula Young Professionals. We're all here thanking everybody for joining. We are going to be giving away a free home buyers class, and I think we have the pick. Taylor?
It's Russ Peterson.
Oh, Russ.
No way.
Hey, Russ, you won. Hey, that's awesome.
That's true.
Participating the whole time, so
Oh,
great.
wow.
If you could just type your email into the chat.
No,
And-
we
or-
have his email.
Oh, we have your email. Never mind.
From registration.
Yeah, oh yeah, from registration. Yeah, thanks, sorry. Great. Yeah, so just to wrap it up, thanks to Opportunity Mortgage, Barb and Steve. That was awesome. Thank you guys for doing that so much. Thanks for all the questions that came into us and on the chat. And also just kind of wanted to plug that we are doing our first in-person event since COVID happened, and that'll be in the next few weeks. We'll be announcing that on our Facebook page, on our Instagram, if you guys want to go follow that. And I think that's it. Yeah.
Thank you.
Yeah, thanks everybody for joining.